Wagwan, welcome back to my channel. My name is Dreycosting. If you're new here, what we do over here is analyze the financial market, chop it up in pieces, all right, and just break it down. Today, we're going to look at what is the stock market. All right, so let me tell you how the stock market works and why the stock market is needed. So when a company decide that it want to grow, it want to expand, you could either look for growing organically, right? Getting the funds from profits and expand. What if they need to buy more assets? They are open a next location, whether locally or internationally, or to just invest in more products. So if the company has that funding internally, what the company would seek to do is to look publicly for that funding. That company will go to the stock exchange to try to get registered on the stock exchange. They would have to meet a lot of criteria that the stock exchange has before they're eligible to be registered on the stock exchange, right? They have to have some good corporate governance and the board structure system well set up, internal auditors, proper internal controls, and so much more. So they have to pass these criteria for the stock exchange. So there are various stock exchanges across the world. You have the New York Stock Exchange, the London Stock Exchange, Sydney Stock Exchange, Frankfurt Stock Exchange, the Jamaica Stock Exchange, right? So you have a lot of stock exchange across the world, right? So what happened now is that once the company has met these criteria for the stock exchange, then now the company or the board of directors will create what you call a prospectus, right? Within this prospectus, it outlines who governs the company, what the company is about, right? Why they need the funding, and how they're going to utilize the funding. It also shows past financial information, right? It shows what goes on the income statement, the balance sheet, right? As well as the cash flow. It will also show projected financial statements within this prospectus, right? And it would outline the business plan going forward for at least the next 5-10 years. So let people know that, right? This is a good company to invest in, right? So after the prospectus has been issued, right? Then now what we'll have is the stock exchange put out a advertisement for this company as an initial public offering, right? An IPO. So this is the process of an IPO, right? So once that initial public offering is sent out to the market, it will now invite the public, right, to come in and purchase these stocks, right? So once the public start to purchase these stocks, that money now goes from each individual from the public to the stock exchange, and the stock exchange now will pass over those funds to the company, and the company now will now use those funds, right, in order to fund in their assets or expansion or whatever they needed to do, right? When the company actually issue out these stocks on the stock exchange, they have what you call an authorized capital, right? Say authorized capital is 10 million, right? $10 million, right? So they're seeking funding of $10 million, or they put it just above what they're seeking funding for, right? Say they need funding of $6 million, so they probably put it at 10, right? So it's not a must they reach this authorized capital, but what this authorized capital means is what they have been authorized to collect. So they cannot exceed that 10 million, right? When a company issues stocks, right, there are two types of stocks, right? These are ordinary shares and preference shares. Ordinary shares, they always get paid dividends, right? So you get dividends on your money, right? But this is how the hierarchy goes. Preference shares means that those who have preference shares, they're going to be get paid first from the profits, right? So if you're a preference shareholder, you're going to get your money first, right? And the ordinary shareholders get paid after the preference shareholders, right? So that's the difference between ordinary shareholders and preference shareholders. So preference, right? They have the preference over the ordinary shareholders, all right? What is an APO? An APO is an additional public offering. Going back to the $10 million example, right? Say that when the company went on the stock exchange, right? And after the initial public offering, they only got $7 million worth of shares, right? Now they're realizing that they need more money to expand. So the fact they had an authorized share capital of $10 million, what they will now do is go to the market for additional public offering for that $3 million difference. So that is what you call an additional public offering, is going back to the market for more funding after you have went there initially for funding. What are the public obligations of a public limited company? They have issued share to the public. They are no longer a private company. They are now known as a public limited company. So what are the obligations of a public limited company? Some of the obligations of a public limited company and key obligation is producing quarterly unaudited financial statements to the public, mostly on their website. And the stock exchange would also publish this on their website as well. Investors need to know what is going on in the business. From these quarterly statements, it's more like a quarterly annual report. So it gives a breakdown of what's going on in the business, what are the risk factors in the business. It also show the financial breakdown for each quarter, the income statement, the balance sheet, the cash flows, what major acquisition went on during the quarter, what major disposal went on in the quarter. That's one of the obligations. A next obligation of a public limited company is to keep an annual general meeting for its shareholders. So this annual general meeting, right, the shareholders, they come and vote. They can vote in new directors, vote to take off directors. And why they have a vote? Because whenever you own the underlying share of a company, you now own part of that company, right? So if your share is worth 1/10 of the overall capital of the share, which is that $10 million example we spoke about, that authorized share capital, if your share is like 1% or 2% of that, your share amount, then you own 2% of the company. How does somebody take over a company completely, like a Jeff Bezos owns Amazon? Is by owning more than 50% of that authorized share capital. If the same 10 million example, if I own 6 million shares, which is 60% of the authorized share capital, then I'm the majority shareholder of that company. And the fact that I'm the majority shareholder of that company, I have control of that company. In most instances, when you have a majority shareholder, that majority shareholder has control. However, that is not always the case. But we'll get into that in our next video. From this AGM, the shareholders can also appoint auditors. And I'm going to get into auditors in our next video, and to show the role that the auditor plays when it comes to a public limited company. Prices, stock prices. What drives up stock prices up and down? So from these quarterly reports that are coming out from the company, if these reports are good, the income statement is looking good, profit is looking good, management is keeping down its expense, increasing revenue, that way profit can increase. When investors look, the management has a low debt ratio, they're keeping their debt under control. And while they're keeping their debt under control, they're increasing their assets. They're doing good investment, invested in the stock market, invested in property, plant, and equipment. They are expanding. On this expansion, they're bringing in more revenue. So the company is doing good. The company is well governed. From this good look, investor sentiment, right? And if you don't know what I mean by investor sentiment, you should watch my video on type of analysis, right? Right up there. Click on that link above. Watch my video on type of analysis. Investor sentiment will show that this company is a good company. The fact that investors feel that way about it, what that does, that drives up the stock price, because there'll be more demand for the stock price. So if there's more demand and low supply, that will drive the stock price all the way up. However, on the flip side, if the company is doing badly, their expenses are out of control, their debt is out of control. When you're looking at the P&L, the profit and loss, you see a huge loss. Every single quarter, there's a loss. When you look at their assets are not growing. Investors' sentiment will be saying that, no, this company is poorly managed. When you look at the board of directors, you realize that the directors, some of the main directors, the executive directors, they don't have the proper education or the proper experience to steer the company. So what you will have right now is that investor sentiment will be like, no, this is a bad company. So there will be no demand for that stock. And if there's no demand for that stock based on investor sentiment, then the stock price will be going down. How do you make money in the stock market? Once it's a good company and investor sentiment saying that we want to buy more of this stock, the demand is high and the stock price goes up. So if you bought the stock price at the initial public offering of, say, $1, right? Just an example. And the stock price goes all the way up to $50, then therefore you have gained a profit of $49 per share that you have. Times up that by the amount of units that you have, with the dollar value, you work it out, and that's your profit on the stock. Right? I hope this was a good explanation for you guys on how the stock market works. That concludes the video. Don't forget to like, share, subscribe, tell a friend to tell a friend. Just share with your friend, share with your family. I am sure that this information can help a lot of people. And if you're interested in private mentorship in the financial market, please give me a follow on Instagram and DM me, and I'll get right back to you. If you're not on Instagram, then just send me an email, right? And I'll get right back to you. And I can show you and guide you how you can have an edge in the financial market. Big up, everyone.